Welcome to Module 2. We're going to talk about valuing the gift, which for me has always been the most difficult part because so many times I had to get appraisals and I had to make sure the appraiser was one that was acceptable to the IRS. And I would have appraisers tell me, sure, I'm acceptable. And then I would find out they weren't, and then I'd have to have appraisal redone. So this is not necessarily the easiest, although from the financial planning standpoint, it's not that big, but it is certainly for tax purposes, and then you have to be aware of that because you have your fiduciary responsibility. Objectives of this module: describe methods of valuation, discuss complexity of determining the fair market value, list the gift value thresholds that require an appraisal, describe the gifts that do not have a tax deductible value, and discuss the value of making long-term capital gain assets to a charity, which is a fantastic idea of tax avoidance. Value of a gift: generally we can say the fair market value of a gift is the value for gift tax and income tax of the donor. That's a very general statement. Cash and marketable securities are easy as the values are stated and is published respectively. Fair market value can vary drastically based on the facts and circumstances at the time of the gift. It's sort of like if you're in Alaska in winter, oranges are very expensive. If you're in Southern California in winter, for the same orange is very cheap because that's when they come out. General rule is an appraisal needed to prove the value of the gift. Exceptions to the rule: if the gift of the property is under $5,000, you don't need an appraisal. If it's cash, special rules for intellectual property we'll cover later. Publicly traded securities, because again we can look in the newspaper for that. Something from an inventor, and qualified vehicles. Again, some of these have special rules. And cost of appraisal is taken as a miscellaneous deduction on your Form 1040. So it's not the appraisals are not going to be part of your gift. They're going to be a deduction as part of miscellaneous deduction. So if you don't make the itemized deductions, you lose it. Appraisals must be qualified. To be a qualified appraisal, it must have, first of all, a detailed description of the property, the date of the contribution, the valuation date, and a new word I created there for you, qualification of the appraiser, the fair market value of the property, and methods used to determine valuation. Now again, those appraisers who do this for a living, doing for the IRS, have no difficulty in doing this for you. If the individual isn't doing this for you, they probably really aren't qualified. Remember, there's two types of appraisals. One for insurance purposes, where you want the appraisals very high, and one for tax purposes, generally you want it very low. And for gifting, however, is a special. You want it high. So this is one of the rare times for taxation purposes, you want a high appraisal value. And again, the people who do the high appraisal value for you are the same ones who do the low appraisals for taxation. So you have to remind them that this is a gift and make sure they remember that, because your answer is going to be different. Realize also the government has their own appraisers, and sometimes there's this argument among the appraisers. Well, I'd say in many cases. Ordinary income property: there's short-term capital gain property, there's inventory, there's depreciation, recapture property, life insurance and annuities, accounts and notes receivable, and the value of the gift is less of the adjusted basis of fair market value at the time of gift. So again, this is not a lot of advantage. Not a lot of advantage to you. It's probably a disadvantage to get this type of property. There are times how you do it. For example, in the Haiti earthquake, I remember a lot of companies donated goods out of their inventory. Long-term capital gain property has got double tax benefits, as an owner is allowed deduction based on the fair market value of the gift, which is fantastic, not on the basis, and you don't pay tax on the appreciation of the property provided to the charity. So if I have an asset that I bought for a stock for $5, it's worth, make it $5,000 today. If I sold it, I pay a hell of a tax. If I use it for charitable purposes, I can use the fair market value and get a tax deduction for that full $5,000. Saves a lot of money in taxes. For tangible personal property, items that you can touch, feel, rather than like stocks and bonds. The planner must be very careful in this area, as wrong advice has have major consequences, because works of art, musical instruments, collectibles are deductible at fair market value if use by the charity is related to its charitable purpose. For example, a statue to a museum. But if you give a computer to a museum, it's not the use related. So you have to make sure it's use related. And again, what may seem logical to you as a financial planner may not seem logical to the IRS or tax preparers. So you really need advice from either the IRS or a tax preparer before you make recommendations on what items to give if it's a tangible personal property, because you're probably going to guess wrong, just as I do. If use is not related to its charitable purpose, the gift is limited to its adjusted cost basis. Anything almost new computer to museum is adjusted cost. It doesn't get the advantage of fair market value. And the special appraisal personnel for valuing artwork, and in fact, if it's large enough, the IRS does the appraisal. So you've got to realize there's some things that are more beneficial to gift and some things that aren't. And this is some of the basic rules. And they're covered very well in your textbook, by the way. Miscellaneous rules. Clothing, household items must be in good use condition. If items over 5,000, appraisal is required. So if you give away your used clothes that you had that's got holes in it, that's not really good. Now, I'll be candid, some of them like Goodwill and Salvation Army, when they come around with the trucks, they give you a receipt blank to fill in. You still have to identify all the clothing individually and state, in your opinion, what the condition of the clothes was. And again, you might remind this client that that's a they to fill it in, because most of the time the charities let you fill it in. Donated vehicles such as autos, boats, and airplanes are sold to charity as is. The value of the sale is gift. If not sold, then Blue Book value is used. So we have to know whether the charity is going to keep it or sell it before we can fill out the tax return. And again, you have to get with the client to make sure your client gets that information. Real estate transferred to public charities is at its fair market value, whereas it to a private charity is at its adjusted basis. Again, public charities are the ones typically we think of: Blue Cross, Blue Shield, I'm sorry, not Blue Cross, the Red Cross, Salvation Army, churches. Private annuities are Ford Foundation, Getty Foundation, so they're different. And we'll talk more about those different later. Securities, gifts of closely held stock over 10,000 requires an appraisal, and the deductible value is the same as deductible value for gifts of appreciated property. Note, however, that valuation discounts will be used by the IRS, reducing the value of the gift. There's the minority discount, there's the lack of marketability discount. So where you may think the value of the stock is worth $20,000, they may say it's worth $12,000. So just be aware of that, and that probably means it's not a good thing to gift, right? Life insurance value for gifting to a charity is its replacement cost and is treated as gift of ordinary income property. And a replacement cost is basically what it would cost to buy a new policy today. You have to get that information from the insurance company, because there's no way you or the tax preparer or your client can figure it out on their own. And the special appraisal personnel in the government that's there to analyze your insurance. So again, you need to get the insurance industry to help you, or the insurance company rather. Summary: in this model we learned the need for appraisals for many charitable gifts. And again, the cost of that appraisal is a miscellaneous expense. It's not a part of the charitable deduction. And many people do that wrong, especially if they don't have itemized deductions. They feel, I'm going to lose that cost. Well, you lose it. Cost of the appraisal can be very high. I have been involved where the appraiser charged $50 for each of the paintings or artwork, and the person had like 30 of them that they were giving away. The de minimis value gifts of personal property are not tax deductible. In other words, if it's low value, used clothing, it's very tough to argue that it's worth anything. However, if it's something you bought, like a suit at Nordstrom's that was used 3 times and you gained weight, That would be a good example of a gift that would be very deductible. The fair market value gift can be very subjective and have a wide variance of value. So that's why there's so many discussions between the appraisers of the government and your appraisers. And again, I might note to be sure not to use an insurance appraiser, because you're going to come up with not only a IRS that's very unhappy because they have certain appraisers they recognize and use, and if you don't use them, you're probably going to have a few problems that you didn't plan on. So that sort of summarizes enough information to get us thinking about what should be given based on the valuation for charitable purposes and what doesn't make a lot of sense to do.